Welcome back to the Deep Dive. It is Thursday, January 22nd, 2026. And before we get into this just massive stack of reports on my desk, I want everyone to just take a second and look at their phone, okay? No, seriously. Open your banking app. Because if you have been paying attention to the financial headlines over the last 12 months, I mean, really paying attention, you know that the numbers you're looking at on that screen, they mean something completely different today than they did just a couple of years ago.
It's been a complete pivot point. Honestly, I don't even think pivot is a strong enough word. It's been a total rewrite of the operating system of money. It really has.
Yeah, a rewrite. I like that.
Yeah.
Let's just rewind the tape for a second to, 2023 or 2024? When we talked about crypto back then, what was the vibe?
Oh, chaos. Absolute chaos.
It was chaotic. It was meme coins. It was when Lamborghini, it was Discord servers full of people just, gambling on pictures of dogs.
Right. And the narrative was that this technology was an insurrection. It was going to burn down the banks.
It was us versus them. 100%.
It was a rebellion. The whole idea was to replace the entire system.
But looking at this stack of research we have today, and we have a serious stack. I mean, reports from Anchorage Digital, Galaxy Research, Visa, Block Invest, that whole narrative has just flipped on its head.
Completely. The insurrection is over.
It's over. And the guys in the hoodies, they didn't burn down the banks. They started wearing suits and working with them.
The dust has settled. And what we're seeing now, it's not a revolution that destroys Wall Street. It's a revolution that upgrades it.
We're calling this deep dive Wall Street 2.0. Because it turns out the killer app for blockchain wasn't, replacing the US dollar with Bitcoin. It was making the US dollar faster.
Exactly. It's not about going to the moon anymore. It's about something much more practical and, I'll admit, a lot less sexy on a billboard.
Yeah.
It's about T+0 settlement.
Okay, T+0 settlement. I can just hear the listeners' eyes glazing over already. That sounds incredibly, incredibly boring.
Yeah.
Why should anyone who isn't like a back office accountant care about that?
It sounds boring until you realize what it actually unlocks. We're talking trillions of dollars in capital efficiency. T+0 just means instant. That's all.
Instant.
It means money moves as fast as an email. And when you realize that the global financial system has been running on the equivalent of, like, the Pony Express for settlement, literally taking 2 full days to actually move an asset, you start to realize that making it instant changes the fundamental physics of money.
So we really need to unpack this because we are sitting here in early 2026 and the plumbing of the financial world has officially, definitively changed.
It has.
We're going to talk about the onshoring of digital dollars, what that means, why it matters. We're going to look at the massive rise of real-world assets, or RWAs. This is just a fancy way of saying putting regular investment on the blockchain.
And we're going to climb this complex new hierarchy of yield, which is really just the answer to a very simple question. How does your money make money now?
It's a whole new world.
And we have to start with the regulatory breakthrough. We just have to. Because for so long, the biggest hurdle here wasn't the tech, it was the law.
Right. The big question from all the institutions was, is this legal? If I touch this, is the SEC going to sue me into oblivion?
Exactly. And in 2025, we finally got a clear answer.
So let's jump right into the headline event that really kicked all this off. Anchorage Digital. They launched something called USDTB. Now, we've had stablecoins for a decade. USDT, USDC. Everyone knows those names. Why is USDTB such a big deal?
So USDTB is America's first federally regulated stablecoin. That is the headline. That's the whole ballgame.
Federally regulated.
Yeah. It was issued by Anchorage Digital Bank, which isn't just some tech startup. It is a federally chartered crypto bank. And they did this in partnership with Athena Labs.
Okay, federally chartered carries a lot of weight. That's not a term you just throw around.
It changes the entire conversation. USDTB circulates under the direct supervision of the Office of the Comptroller of the Currency, the OCC.
The OCC, the U.S. Treasury.
The Treasury. This isn't a tech company in a trench coat pretending to be a bank anymore. This is a bank. And the reserves, this is the best part. They aren't held in some mysterious commercial paper nobody can audit.
Right.
They're invested almost entirely in BUIDL.
BUIDL, that's BUIDL. BlackRock's Tokenized Treasury Fund.
Correct. So let's just pause and absorb that. You have a digital dollar regulated by the OCC, fully backed by BlackRock's management of U.S. Treasuries, It is the ultimate establishment crypto product.
It's the opposite of the rebellion narrative.
It's the complete opposite. It represents this massive shift toward onshoring innovation. For years, the biggest stablecoins were these offshore, kind of shadowy entities. Now, the U.S. is positioning itself as the gold standard for this stuff.
And this didn't just happen in a vacuum. I mean, we have to talk about the legislation that made this possible. The Genius Act.
Right. Signed into law back in July of 2025. The Genius Act was the watershed moment. It finally established clear, unambiguous guardrails for stablecoin issuance, for the reserves, for redemptions. It basically gave the big banks the green light they've been waiting for to actually touch this technology without fear of getting shut down.
But there is a really important catch in the Genius Act, isn't there? I was reading the Galaxy Research report on this, and they pointed out a very specific, very intentional nuance about interest.
This is where it gets absolutely fascinating, and it really sets up the rest of our discussion today. The Genius Act explicitly prohibits issuers of regulated payment stablecoins from paying interest to the holders.
Wait, let me make sure I'm hearing this right. If I hold USDTB, this new, super safe, federally regulated dollar, I don't get paid any yield for holding it.
Not directly from the issuer, no, and that is 100% by design.
Why? That seems counterintuitive.
Well, the regulators want to maintain a very strict, very clear divide between money for payments and money for savings. If a stablecoin paid interest directly, it would start to look and feel a lot like a bank deposit, but without the traditional FDIC insurance structure in the same way.
Ah, okay, so they're trying to avoid blurring those lines.
Exactly. They drew a hard line in the sand. Payment tokens are for spending. If you want yield, if you want your money to make money, you have to consciously move it to a different layer of the stack.
So it creates this fork in the road for your capital. You have your lazy cash for spending, and then you have your working money for saving and investing.
You've got it. And that brings us perfectly to the second pillar of this new system, this whole idea of Wall Street 2.0 and companies like Ondo Finance.
Ondo has been everywhere lately. I mean, their pitch is basically democratizing institutional finance. But what does that actually look like in practice? Because democratizing finance is usually just, marketing speak for, we want your fees.
Laughs. Often true, yes. But in this case, the utility is very, very real. Let's think about the old way of doing things. You buy a treasury ETF, right, on a traditional brokerage. Let's say you buy it on a Friday afternoon.
Okay.
Then, over the weekend, something happens in the market and you want to sell it. You hit the sell button, but you don't actually get that cash available to withdraw or use for 2 business days. That's T+2 settlement.
Glacial. In the internet age, 2 days is just an eternity.
In a world of 247 crypto markets, 2 days is an absolute deal breaker. It's a massive point of friction. Ondo looked at that and said, this is absurd. We can do better.
So what do they do?
Well, for their OUSG fund, that's their short-term U.S. government treasury product, they moved the underlying assets into BlackRock's BUIDL.
Okay, so connecting the dots here. Because BlackRock put the ownership record of those treasuries on the blockchain, Ondo can now use them to offer instant redemption.
Precisely. It allows for 247 minting and redemption. You don't have to wait for the stock market to open on Monday morning at 9:30 a.m. You can move millions of dollars of treasury-backed value at 3 a.m. on a Sunday if you want to.
That is the operational efficiency that institutions were craving.
It is. It proves that the big wave of adoption we saw in 2025 wasn't driven by hype or speculation. It was driven by CFOs and treasurers needing better, faster cash management tools.
So OUSG is for the big institutional players, the qualified investors. But Ondo has a product for the, let's say, regular investor too, right? Or at least the non-US investor.
Yes, and that's USDY, the Ondo US dollar yield token.
Which, frankly, sounds like what a stablecoin should have been all along. It's a dollar that actually pays you interest.
In a way, yes. It's a tokenized note that's secured by a combination of short-term U.S. treasuries and bank deposits.
Yeah.
But because of those U.S. securities laws we mentioned, specifically something called Regulation S, it's not available to U.S. retail users.
Okay, so it's for the global market.
Right. And for the non-U.S. investors who can buy it, there's a catch.
Of course. There's always a catch.
It has a 40 to 50-day lockup period after you purchase it.
Oof. That's a long time in crypto. A lot can happen in 50 days.
It is. It's to comply with the law to prevent it from immediately flowing back into the U.S. market. But the goal for USDY isn't just for it to sit in your wallet. Ondo envisions it as a money Lego.
A money Lego?
Yeah. Once that lockup period is over, it's a bearer asset. You can take it anywhere. You can use it as collateral on Ethereum, on Solana, on Sui.
It becomes a fundamental yield-bearing dollar that circulates throughout the entire DeFi economy.
And the market for this stuff is just exploding. I'm looking at the data here from rwa.xyz. The total market for tokenized U.S. Treasuries is now over $9.35 billion. That is not a small pilot program anymore.
It's seen huge growth, and look at the leaderboard. You've got Securitize, Ondo, and Circle, sure. But then you have Franklin Templeton with their BNG token.
A traditional finance giant.
A huge traditional player is heavily involved here. This is not a niche crypto experiment.
And the Block Invest report made a really interesting point about who is actually buying this stuff. It's not just Goldman Sachs or JP Morgan moving their money around.
No, not at all. A significant chunk of the demand in 2025 came from what they call non-traditional buyers.
What does that mean?
We're talking about crypto foundations, DAO, treasuries, tech startups that raised a bunch of cash in stablecoins like USDC. They were sitting on hundreds of millions of digital dollars and needed a safe, productive place to park that capital that was still on-chain.
So they didn't want to off-ramp to a traditional bank account.
Yeah.
That would create friction.
Exactly. They wanted the operational efficiency of the blockchain, but the safety and yield of U.S. Treasuries. That was the perfect product market fit.
Okay, so this is all starting to make sense. We have the regulated stablecoins for payments, the ones that pay zero. We have the tokenized treasuries for savings, which pay the risk-free rate. But the Galaxy research paper, it really broke down this hierarchy of on-chain yield in a way that just blew my mind. It's like a ladder.
It is a ladder of increasing risk and increasing reward. And if you want to understand finance in 2026, you can't just look at the price of Bitcoin anymore. You have to understand this ladder.
So let's climb it. Tier 1, the bottom rung. Galaxy calls this non-yield bearing, the basement.
This is your cash layer. This is your USDT, your USDC, your FDUSD. When you hold these tokens in your wallet, you earn exactly 0%.
Which is just crazy when you stop and think about it, because the issuer Tether or Circle is holding tens of billions of dollars in U.S. Treasuries backing those coins. They're earning 4% or 5% on all that capital.
Billions of dollars a year in interest. They keep all of it. By holding their coin, you are essentially providing them with a massive interest-free loan.
Wow.
The Galaxy report calls this the opportunity cost. You are effectively donating that yield to the issuer in exchange for the convenience of having a liquid, stable digital dollar that works everywhere. It's the price of admission.
Okay, so that's the basement. Let's go up one step. Tier 2 is platform-dependent yield.
This is a bit of a loophole. The coin itself, the USDC, doesn't pay you. But if you hold that USDC on, say, Coinbase, they might share some of the revenue they're making with you.
So it's like a rewards program.
It's exactly like a rewards program. It's a commercial partnership. It is not an inherent property of the token itself. The second you move that USDC to a private wallet or a ledger, that yield stops. Instantly. You're completely dependent on the platform's good graces.
Got it. Okay, so Tier 3 is where things get interesting. This is where the token itself starts to work for you. Galaxy calls this debt-based and staked strategies. But I think a better name for this rung is the workhorse layer.
That's a really fair description. This is where we see that definitive shift we talked about from lazy money to working money.
And what are the prime examples here?
Well, you have things like SDAI, SUSDS, and of course the big one from 2025, SUSD from Athena.
Athena, we mentioned them earlier with the Anchorage partnership. But their own token, SUSD, is it?
Yeah.
It's a different beast entirely. It's not just backed by treasuries, right?
No, and that's why the yield is higher and why the risk profile is different. Athena generates its yield through what's called a delta-neutral hedge.
Okay, stop right there. Delta-neutral hedge. That is exactly the kind of finance jargon that makes normal people just tune out completely. Break that down for us. Pretend I'm 5 years old.
Okay, fair enough. Imagine a seesaw. A perfectly balanced seesaw.
Okay, got it. Seesaw.
On one side of that seesaw, Athena buys and holds actual crypto assets. Let's say Ethereum. They just hold the token. So if the price of Ethereum goes up, that side of the seesaw goes up.
Right? Simple enough. I own ETH. Price goes up. I'm happy.
But at the exact same time, they go to the futures market and they short the exact same amount of Ethereum.
Shorting. So betting the price will go down.
Correct. So now look at the seesaw. If the price of Ethereum crashes, the spot ETH they're holding loses money. But their short position makes the exact same amount of money. The loss on one side is perfectly canceled out by the gain on the other. The seesaw stays perfectly flat. It doesn't move.
So they don't care if the market moons or if it crashes. They are neutral to the price movement, hence delta neutral.
Precisely.
They have completely neutralized the price risk of the underlying asset.
Okay, my 5-year-old brain is following. But if the seesaw never moves, how do they make any money? Where does the yield come from?
That's the million-dollar question. It comes from two places. First, the Ethereum they hold isn't just sitting there doing nothing, it's staked. So it's earning that Tier 4 network reward we'll get to in a minute. But the real magic, the real engine of the yield is something called the funding rate.
The funding rate.
In crypto markets, people love to gamble, they love leverage, they want to bet more money than they actually have.
The degen.
The degens. To do that, they have to borrow from someone. When the market is bullish and everyone wants to bet that prices will go up, they have to pay a fee to keep those leveraged bets open. Athena is essentially the casino collecting all of those fees. They are taking the short side of the trade, which allows all the speculators to take the long side. And those speculators pay Athena for the privilege.
That is a fascinating and slightly terrifying business model. So the yield is just coming from speculator fees.
A large portion of it is, yes. Athena collects those funding fees, combines them with the staking rewards from the ETH, and passes all of that on to the holder of the SUSD token.
And back in early 2024, this was paying, what, 50% APY?
It was, which understandably sounded like a Ponzi scheme to a lot of people.
It sounded way too good to be true.
It did, but as the Galaxy report correctly notes, in 2025, as the market matured, those yields compressed significantly. We aren't seeing 50% anymore. We're looking at a much more, steadier band of 7% to 12% now.
7 to 12%, which is still double or triple what even a high-yield savings account offers.
It is, absolutely. But you have to understand the risk profile is different. This isn't the U.S. government promising to pay you back. This is a complex derivative strategy running on a crypto exchange. It's been remarkably stable, but it is not risk-free.
And a key mechanic here is that they don't airdrop you new tokens every month, right? It's not like getting a dividend check in the mail.
Right. It's what's called an accumulating token. The value of your SUSD token just goes up over time relative to the dollar. It just quietly accrues value. It's cleaner, it's more tax efficient, and it's much easier to integrate into other protocols.
Okay, moving up the ladder, Tier 4, protocol-based yield. This feels like the real crypto-native stuff. This is staking.
This is the engine of the blockchain itself. You lock up your ETH or your SOL to help secure the network. You become a validator or you delegate to one. In exchange, the network pays you from its inflation and from transaction fees. You are literally getting paid to keep the global ledger accurate and secure.
But then we have this new layer on top of that, restaking and things like eigenlayer. This feels like where greed starts to creep back into the picture a little bit.
It's about capital efficiency, but yes, it comes with greed's close cousin,
right.
Leverage. Restaking takes that staked ETH and it puts it to work again.
Double dipping.
It's double dipping. You're essentially telling the network, I promise to secure the Ethereum blockchain, and I also promise to secure this other service like an Oracle or a data network or a bridge with the exact same capital.
So you get double the rewards.
You get double the rewards, but you also take on double the risk. This introduces what's called slashing risk. If your validator messes up or the other service you're securing has a bug, the network can programmatically seize a portion of your funds as a penalty. It is not a free lunch. You are actively taking on operational risk for that extra yield.
And finally, we reach the top of the ladder, Tier 5, structured yield. This is where my brain starts to hurt.
This is pure financial engineering, and the poster child here is a protocol called Pendle.
I have tried to understand Pendle 3 different times. It feels like 4D chess. Please make it simple for us.
Okay, I'll try. Imagine you have an apple tree. The tree itself has value, right? As wood. That's the principal asset. But it also produces apples every season. That's the yield.
Okay, tree and apples, got it.
Pendle lets you chop that asset in half, metaphorically. You can sell the wood, the principal token, or PT to one person, and you can sell the rights to all future apples, the yield token, or YT to someone else entirely.
Why on earth would I want to do that?
For speculation and for hedging. Maybe you think the price of apples is going to skyrocket next year because of a drought. You can buy just the yield token for very cheap. If yield rates go up, your YT token becomes incredibly valuable and you make a killing.
Ah, so you're just betting on the future yield.
Exactly. Or maybe you want a guaranteed fixed return. You don't want any risk. You can buy the principal token at a deep discount, knowing that at a certain date in the future, it will be redeemable for exactly one full token. It's like a zero coupon bond.
So it turns yield itself into a tradable asset class.
That's it. And then you have tools like Boros that build on top of this and automate complex strategies. They do something called looping.
They'll take a yield-bearing asset, use it as collateral to borrow more money, use that money to buy more of the asset, and just repeat that loop to amplify the returns.
It's basically Wall Street hedge fund strategies, but fully automated and accessible to anyone with an internet connection.
That's the theme of this whole new world, isn't it?
It really is. Okay, so we've talked a lot about saving and investing, but what about the other side of the coin? Borrowing. The credit market. According to this report from Visa and Allium, this part of the ecosystem is quietly becoming an absolute monster.
The numbers are just staggering. Over $670 billion in stablecoin-denominated loans have been processed in the last 5 years.
670 billion.
Yeah, and in August 2025 alone, the monthly volume hit $51.7 billion. This is not a small market anymore.
And Visa makes a point to say that this isn't just traders leveraging up to buy more Dogecoin. This is real economic activity taking place.
No, it's not. This is becoming what they call global credit markets that never close. And one of the key innovations driving this is a protocol called Morpho.
Morpho sounds like a comic book villain.
Right.
Idomorpho, destroyer of worlds.
Laughs. It's actually a very benevolent piece of code, I promise. Morpho is a lending protocol, but it works very differently than the old guard, like a Fay or Compound. It's an aggregator.
How so? What does that mean?
Think of the old way as a giant communal swimming pool. Everyone throws their money in, and borrowers come and take it out. It's safe, but it's not very efficient.
Sure.
Morpho is more like a matchmaking service. It connects individual lenders directly to individual borrowers. It aggregates liquidity from all over the ecosystem, from places like Coinbase wallets or Ledger wallets. Because of this efficiency, it can offer lower borrowing rates to borrowers and higher lending rates to lenders.
Cutting out the middleman.
Essentially, yes. They're doing about $1.7 billion in monthly volume now, and something like 90% of that is in USDC. It's becoming a core piece of infrastructure.
And Visa highlighted some real-world use cases here that I found genuinely surprising. Corporate cards.
Yes. Look at a company like Rain. They are a corporate card issuer. Usually, a card issuer needs massive lines of credit from a traditional bank to fund the float.
The float being the time between when an employee swipes the card and when the company pays its bill.
Exactly. Rain is using on-chain credit markets, like Morpho, to fund that float. It's faster and more efficient for them.
So the liquidity providing the credit for a corporate expense account at a coffee shop might be coming from a DeFi protocol on the other side of the world.
That's exactly what's happening. Then you have Huma Finance, which is doing trade finance.
Less invoices, that kind of thing.
Yes. Imagine a small business in an emerging market, say a supplier in Brazil. They have an invoice they need paid today so they can buy materials, but their customer in the US won't pay for 30 or 60 days. Huma uses stablecoins to advance that money to them instantly on-chain.
That's a huge deal.
It speeds up cross-border payments in a way the traditional banking system simply cannot match. It's using the speed of crypto to solve the slowness of fiat. It's bridging the gap.
And that is why a company like Visa is interested. They see the writing on the wall. Stablecoins aren't just for payments anymore. They are the new rails for credit.
It creates a truly global credit market that is agnostic to your geographic location. It only cares about the quality of your collateral.
Okay, let's look at the infrastructure that's powering all of this.
Yeah.
Because while we're talking about these cool new financial products, the tech stack underneath it all is evolving just as rapidly. The granddaddy of DeFi lending, they're not just sitting still.
Not at all. Aave just released v3.6 in January of 2026. And their strategy is simple: ubiquity. They're deploying their markets everywhere, on new chains like Sonic, Celo, Linea, Scroll.
They want to be the default liquidity layer for every single blockchain.
They do, and they introduced something really interesting called the Umbrella Safety Module.
Which sounds very safe and comforting.
It is. It basically uses staked-off tokens as an insurance fund. If the protocol ever takes a major hit from bad debt or a hack, the stakers in the safety module are the first to absorb the loss. It's an automated on-chain insurance policy, which makes the whole system much more robust and attractive for institutional players who can't afford that kind of catastrophic failure.
And then going back to Ondo for a minute, they're taking a completely different approach. They aren't just building products on other people's chains. They're building their own playground, the Ondo chain.
This is a classic case of vertical integration. Ondo looked at the current landscape at Ethereum, Solana, Avalanche, and they basically said, look, these are incredible pieces of general-purpose technology, but they were built for everyone. They weren't built specifically for Wall Street.
So what does a blockchain built for Wall Street actually look like? Is it just slower and more expensive?
No, quite the opposite. It's all about compliance and removing friction. On a chain like Ethereum, anyone can create a wallet. It's anonymous by default. For a regulated bank or a securities issuer, that's a compliance nightmare.
Right. KYC, AML, all of that.
All of it. OndoChain handles identity verification and compliance checks at the native protocol level. The compliance isn't a bolt-on application. It's baked into the foundation of the chain itself.
But the feature that really jumped out at me in the report was this concept of RWA staking.
Yes. This is, I think, one of the biggest innovations of the last year.
Explain this. Because usually, to secure a proof-of-stake network, I have to go out and buy a volatile crypto token. I have to buy ETH or SOL, hope its price doesn't crash, and then lock it up to earn rewards.
Correct. Which creates a massive barrier to entry. If you are a pension fund or a corporate treasury, you probably don't want to hold $100 million of a volatile crypto token on your balance sheet just to use the network. On OndoChain, you can stake your tokenized U.S. Treasuries.
Wait a second. So the security of the blockchain network itself is being backed by the full faith and credit of the United States government.
In a very real sense, yes. You're using the safest, most trusted asset in the traditional financial world, U.S. Treasury bills, to secure the rails of the new financial world. And it gets even better. You can use those same RWAs to pay for your gas fees.
This is the gas token problem. I've had this happen 100 times. I have $1,000 of USDC in my wallet, and I want to send it to a friend, but I can't because I have $0 worth of ETH to pay the gas fee. It's the most infuriating user experience.
It's a terrible user experience. It's like trying to send an email, but being told you need to go buy a special digital stamp using a different foreign currency first. It makes no sense.
So Ondo solves this.
Ondo solves this. You can just pay for your transaction fee with a tiny slice of the tokenized treasury bill you are already holding. It's seamless.
That feels like the moment crypto stops feeling like crypto and just starts feeling like finance.
That is exactly the goal. It removes the friction. It makes the blockchain itself invisible to the end user.
And that aligns perfectly with the big outlooks from the Block Invest report. Their 2026 forecast had a very clear verdict on who won the last year.
Their conclusion was stark, and I think very accurate. The winners were the integrators. It wasn't the disruptors who tried to burn Wall Street to the ground. It was the projects that built bridges and integrated with the existing systems. JP Morgan's Onyx platform or Goldman Sachs integrating with BNY Mellon.
The hybrid models.
Exactly. Blockchain settlement happening inside of a traditional custody environment. The Block Invest report highlighted that real institutional adoption didn't happen by forcing institutions to move everything to a MetaMask browser extension. It happened by bringing the blockchain into the systems and workflows they already know and trust.
It's the mullet of finance. Business in the front, crypto in the back.
Mullet strategy.
I'm stealing that. But yes, the user interface looks and feels like TradFi, but the settlement layer under the hood is pure DeFi. That is a winning formula for 2026.
So, wow, we have covered a lot of ground here. From USDTB and regulated dollars to all the layers of yield, the new lending markets, and these purpose-built blockchains. If we zoom out, what does this all mean for the listener? What's the so what?
I think if you are the learner, the single biggest takeaway is that the financial system has fundamentally changed its metabolic rate. It used to be slow, it used to be opaque, and it used to be siloed. Now it is becoming transparent, it's becoming instant, and it's becoming deeply interconnected, and potentially a lot more profitable for the average person.
If you are willing to step out of lazy cash, that's the key. We are rapidly moving toward a world where keeping your money in a zero-interest checking account is actively costing you money, not just because of inflation, but in raw opportunity cost. The tools now exist for everyone to have their money working for them 24/7 on-chain with relatively low friction.
It's more transparent, it's faster, but it requires you to be an active participant. You have to understand the difference between Tier 1 and Tier 3 on that yield ladder we talked about.
You do. You have to understand the risks involved. But the access is there for the first time. That's the real democratization. You don't need to be an accredited investor with $10 million to access these kinds of yields anymore. You just need an internet connection and a willingness to learn.
I want to leave our listeners with one final kind of provocative thought, something that really struck me when we were discussing the Ondo chain and this idea of staking U.S. treasuries.
Go for it.
If U.S. treasury bills, which are essentially just the debt of the government, can be tokenized, and if they can then be used to secure a blockchain network, and if they can also be used to pay for transaction fees on that network, Are we witnessing the end of fiat currency as a distinct and separate category from investment assets?
That is the big mind-bending question, isn't it?
I mean, when money itself earns money by default, does the very concept of a checking account just become obsolete? Why would I ever choose to hold a dollar that doesn't grow?
It completely blurs the line. In the past, you had your money to spend and you had your assets to save. If your spending money becomes a productive asset in and of itself, the velocity of money changes. The psychology of spending changes. It's a paradigm shift that we are just at the very, very beginning of understanding.
Something for you to mull over the next time you check your bank balance today. Just ask yourself, is my money lazy or is it working for me on chain?
It's a question worth asking.
Thanks for diving in with us. We'll see you on the next one.
Take care.